Hey everyone, it's Jana Stafford with BIC Magazine. Today I'm joined by Dr. Dean Foreman, Chief Economist of the American Petroleum Institute. Dr. Foreman is an expert in the economics and markets for oil and natural gas, with more than 2 decades of industry experience in forecasting and market analysis, corporate strategic planning, and finance risk management. Dr. Foreman is here to talk to us about the recent divergence in the U.S. energy revolution and how, as consumers, this has impacted us at the pump. Thank you for talking with us today, Dr. Foreman.
Excellent. Jana, thanks so much for having me.
Good, thank you. Can you tell us about the recovery of the oil and natural gas markets so far in 2021 since the fallout of the 2020 COVID-19 recession?
It's really been astounding. And as you mentioned, it really has been a theme of one of divergence. So we've seen the demand for both oil or petroleum products and natural gas rebound strongly along with economic growth. But the investment, the drilling, and consequently the supplies of both have not been able to keep pace with that demand growth. So in August, by API's estimates, U.S. oil demand rose to over 21 million barrels per day in August. It was actually above the same level of where it was in 2019. And by contrast, the production, if we just look at last week per the U.S. Energy Information Administration, production last week was fully 3 million barrels per day below its peak level in March 2020. So now we've got crude oil inventories at their lowest levels since September 2019. The U.S. has returned to being a petroleum net importer for 5 of the past 6 months. And a combination of demand outstripping supply, lower inventories, and higher imports has historically been a recipe for higher prices.
Yeah, I could see that. What has happened since the COVID-19 recession in regards to U.S. natural gas?
Well, it's a similar story, but with relatively steadier production. Drillings continued to be down as the after effects of the 2020 COVID-19 recession. For natural gas drilling across every major basin in the US, on average, productivity is at record levels or near it. And producers have been leveraging their inventories of wells that have been drilled but uncompleted. And those have been drawn down more than 30% so far this year per EI's estimates. So consequently, the net of these changes, that marketed natural gas production has actually increased slightly this year, despite those challenges. And the combined demand for natural gas, though, domestic and exports together, has outstripped that supply as the economy's recovered.
Okay. Well, Dr. Foreman, what does all this mean to our audience as industry participants?
Well, it means a couple of things. And let's take the oil side first. For domestic producers, it's realizing that the time to market, there's a long lead that goes with many of these projects, and how many of, especially the international conventional developments, can take years to develop and get in place. So with limited global spare production capacity, markets could tighten next year if the economy stays on track and oil demand along with it. And this could affect the price levels as well as the relative domestic versus international price levels that we as consumers ultimately see in our fuel prices. For natural gas, though, on the producer side, there's now a two-speed market. You've got those who have access through the value chain to supply premium global markets, and those that really don't and are supplying more for a much slower growing domestic market, and anything more that they produce is really gas on gas competition.
Okay. Well, so what, if anything, do these changes all mean to us as Americans?
Well, these developments really challenge the entire momentum of the U.S. energy revolution that we've seen over the last 5 to 10 years, and the strong jobs and economic benefits that it's brought. It's also raised prices at the same time as we've seen the cost for other things like houses and vehicles and food and healthcare, pretty much across the board, continue to rise so far this year. So, historically and critically, as we look at investment, natural gas and oil industry investment industry-wide for the second quarter of this year had fallen to $37.4 billion. That's actually the lowest level on record for any quarter back to 2008, including the great financial crisis.
Wow. Well, Dr. Foreman, can you talk to us about the effects all of this has had on large capital projects in the U.S.?
Well, in addition to looking at investment as a flow, the $37.4 billion that I mentioned, we also look at this backlog of projects that are currently under construction in the United States. And looking out the window this quarter, we observe $178 billion worth of projects that include pipelines, processing, export terminals, refinery and petrochemical expansions. And if you went back 20 years, 178 billion, we would have been jumping for joy to get the better part of $200 billion worth of oil and gas projects, the likes of which had not been seen in a generation in the United States. But if we're just comparing to 1 year prior, in 2020, as of the third quarter, we were down $110 billion for that same backlog of projects. So a really large drop. And if you think of it as a funnel of things going in and things going out, we've had some project completions. We've had a lot of delays and cancellations, as it's really hard to move multi-billion-dollar projects forward in this environment, and very few projects going in the front end of that funnel. So this is the challenge for the industry.
Okay. Yeah, for sure. Definitely a challenge. What happens if we restrict energy in the U.S. by pausing new oil and natural gas leasing on federal lands and waters?
That's one of many possible policy examples that we could highlight, in addition to revoking the environmental permit for Keystone XL on day one of the new administration, of the jeopardy that the Dakota Access Pipeline's environmental permit has right now. There are a lot of things that there's no question the impact of policies has real consequences. It sends market signals, it adds uncertainty to investments. It can, in some cases, prohibit investments directly. So even these long-run policies that you think of as affecting not something today, but maybe the future, affect expectations and real investments today. If we're looking toward an energy transition, and there's no question that the administration is trying to incentivize that, is actively in favor of that. And I think the industry is also coming around to that and moving onto its front foot as well. But consumers, there has to be a plan for consumers to be able to afford that transition. Oil and natural gas are going to continue to be very important to the US and global economies for decades to come. And we need to have a continued and steady source of supply to be able to meet that demand.
Yeah, for sure.
If you take energy, housing, and vehicles, that's more than half of what a typical household spends in a given year. And all of these things have been going up extremely in price so far this year. And there's a real debate about whether price inflation is temporary or likely to endure. Based on the investments and the long lead nature of them, there may be a misunderstanding of policymakers about how much of current price inflation is actually likely to endure. And I'll give you an additional example, actually. For 5 different segments of our industry, we've looked as of July, not back to 2020, that's an anomalous jump off point, but let's go back 2 years to July 2019, which was a really strong year. Whether we look at chemical manufacturing, whether we look at oil and gas extraction, natural gas liquids extraction, different segments across our industry, we've seen the producer price indexes, the prices compared over 2 years, go up from a range of 12% up to 84% over 2 years. Now, producer prices tend to be more volatile and cyclical than consumer price inflation and the general consumer basket. But even if we go back 30 years, these changes that we've seen over these 2 years would rank in the top 10% of any changes for those categories. So there's no question that there are some large increases and cost escalation coming. And even if we look at current market prices and say, based on the way industry costs have recently looked in the recent past, it would appear that there would be a margin that you should be drilling more. But we have some structural challenges with what we've come out of with the recession last year, from a financial standpoint, from a supply chain standpoint, from a workforce standpoint. If you want to, for example, you've laid off a workforce and you don't have a rig crew or a completion crew. If you want to rehire that, you have to find the people. And frankly, when you go to a service company, you have to commit. You have to sign a contract for 1 to 3 years and be willing to take that risk going forward. So part of it's an aspect of just market dynamics. And part of this is the nuts and bolts that recompiling and finding those resources to bring it forward on top of the supply chain bottlenecks that we have right now could actually mean a step change higher in cost, in addition to the step changes that we've already seen so far this year.
Well, thank you so much, Dr. Foreman, for being with us today. And we look forward to reading your upcoming article in the next issue of BIC Magazine. And for more information, visit api.org, where you can find Dr. Foreman's economic industry outlook, his blogs, and much more. As always, we are most grateful for our audience. Please like and share this recording with colleagues. And for more industry news, videos, webinars, and podcasts, visit bicmagazine.com. And remember, it's what we do together that counts.